If you're under 35 in Australia, you probably ask yourself the question, are housing prices ever going to fall or am I completely screwed? So today we're answering that question. We're going to look at the data, the history, and what actually drives Australian house prices. Because once you actually look what drives the Australian housing market, you're going to realise something pretty shocking. First things first, let's kill a myth. People say that Australian housing prices have never dropped, and that's just not true. They absolutely have dropped, just not by much or for that long. The GFC caused a brief dip. The 2018-19 credit crunch, which was caused by the Royal Commission into Banking, this caused the Sydney and Melbourne markets to drop by about 10%. And then in 2022, the RBA raised rates 11 times in a row, and prices fell across the board nationally. But here's the thing. CoreLogic looked at capital city downturns going back for the last 40 years. And they found that all but 3 lasted less than 12 months. Prices fell and they just bounced back. And this pattern tells us something extremely important. Prices don't need to be affordable in order for prices to recover. Better market sentiment, lower interest rates, a bit of FOMO, and the buyers come rushing back. So where are we right now in June 26? Well, the national picture is starting to crack a little bit at the edges. House values grew about 0.3% in April, the slowest month's growth in the last year. Sydney and Melbourne actually fell 0.6% across the same period. In fact, Sydney's about 1% below its November 25 peak. But if you zoom out and look nationally, the picture's actually pretty strong on paper. House values are up about 10% annually. The total value of Aussie residential real estate just hit 12.6 trillion, with outstanding mortgages of about 2.6 trillion, which gives a loan to value ratio of about 20%. Incredibly low. And that's a big reason why a real crash, is unlikely. The banks aren't exposed, the RBA isn't panicking, and the government is absolutely incentivized to keep prices steady. And here's my blunt take. The system is designed to prevent a crash, not create one. And that's a feature or a bug, depending on which side of the fence you sit on. But just quickly, if you are enjoying the video, hit like, consider subscribing, or check out the affiliate links in the description below. This all helps out the channel greatly, and I really, really appreciate it. All right, let's steelman both sides. First up, the bulls. People who think prices are going to keep climbing forever, or at the very least are going to stay where they are right now. Firstly, supply is genuinely short. In Perth, advertised stock is 40% below the 5-year average. In Brisbane, 29%. Building approvals rose 12% in 2025. But completions are lagging. Construction costs and shortage of trades means that new supply is slow to arrive, and you can't just wish houses into existence. 2, population growth is growing fast. Australia's added millions of people through migration over the last few years, and all of those people need somewhere to live. And most of the net migration is focused into our capital cities, where supply is already the tightest. And number 3 is government policy. The 5% deposit scheme, various other help to buy incentives, all push more buyers into the market, particularly first home buyers. All of this further supports a floor on prices. All right, now the bears, because there are some genuine reasons to be cautious right now. The RBA raised rates twice in 2026 already, taking the official cash rate back up to 4.1%. That's reversed 2 of last year's 3 cuts. And the major banks, economists, according to Canstar, are predicting at least 1 more rate rise in 2026, if not more. So the rate cut tailwind that helped push prices up through 2025, that's gone, well, at least for now. And affordability is genuinely broken. Westpac's time to buy a dwelling index hit 82.9 in March 26, a new cycle low. The long run average is 120. Auction clearance rates have been sitting at less than 60% since mid-March 26. Houses are sitting on the market longer and discounting is starting to creep into the market. The market's not crashing, but the air is certainly coming out of the balloon, particularly in markets like Melbourne and Sydney. If rates stay high, that slow deflation continues. Whether it tips into a proper correction really is dependent on one thing, and that's the RBA's next move. So, will Australia's house prices ever drop? Yes, they will. They have before, and we're already starting to see softer market conditions in places like Melbourne and Sydney. But a national crash where we see a 30 or 40% correction and houses actually became affordable to someone in their 20s and 30s? No. That would require a sustained spike in unemployment, a wave of forced selling, and a government and banking sector that does absolutely nothing to stop it. History shows that's just not how Australia operates. My honest read is that we're in a softening phase, not a crash. Sydney and Melbourne could fall another 5 to 10% from their peaks if we see high interest rates throughout 2026. Perth, Brisbane and Adelaide have a lot more cushion because supply is still tight and values haven't run as far. A meaningful national correction would mean that interest rates would have to remain high for another 12 to 18 months and unemployment would have to rise meaningfully. Neither is off the table, but neither is a base case either. And that's the brutal reality. Australian housing doesn't need to crash for it to feel impossible for an entire generation. Thanks for watching. I'll see you in the next one.